Could the next financial crisis be around the corner? Joining us now in studio to answer that and to give us his 2017 outlook is the best-selling author, Jim Rickards. Jim, welcome back to the studio. So glad to have you back.
Thanks, Danielle. Great to be with you.
And you come with a brand new book, The Road to Ruin.
Yes, thank you. It was New York Times and Wall Street Journal bestseller.
Yeah.
It's out now, and very happy with the response.
But, you know, I guess the main theme in that is that a financial crisis
Correct.
is inevitable. Mm-hmm. But what's the time frame for that, Jim?
Well, it's sort of like asking about the time frame for an earthquake. And I was just saying, because the science is exactly the same. It's not just a metaphor. The unstable system dynamics of a seismic zone and earthquake, tectonic plates pushing against each other is exactly the same as the math in financial markets. Now, if we were standing in Florida and you said, Jim, when's the earthquake coming? I would say, maybe never. Florida doesn't have any fault lines. It's not seismically active. Imagine we're standing on the San Andreas Fault in California and you ask me the same question, Jim, when's the earthquake? I say, well, it could be right now. It could be in 5 minutes. It could be 5 years from now. So the scientific answer, I'm not just sort of throwing up my hands, we don't know exactly when, but what we do know is that we're standing on the fault line. It's dynamically unstable. The next crisis will be worse than any crisis we've ever seen. The reason is that, here's where the human to natural metaphor needs to be expanded a little bit. We're making the San Andreas Fault bigger by making the banks bigger, larger concentration of assets, larger derivatives books, greater interconnectedness. We're actually out there like making the fault line bigger. So the next crisis is going to be worse. What I say to investors is it could be a few years from now. It's unlikely we'll get 5 years. I mean, it's been 8 years since the last one. So these things happen every 7, 8, 9 years. You look at 1994, 1997, 98, 2007.
So you look at cycles.
Oh, well,
right?
Absolutely.
So on
sure.
that note, I was at a conference this week, and we'll talk gold now, where one analyst suggested that gold is in a 20-year bear market, and that we've come off the bounce part of that cycle, but it's probably going to trade closer to the 1050 area for the remainder of this bear market.
Right.
What do you say to people who look at those cycles for gold?
Well, I would say gold is not a commodity. Gold is money. So if you lump gold in as a commodity, so you look at iron ore, zinc, and copper, and I'm not expert in all those base metals or other, cocoa, sugar. I mean, these are all important markets, but I'm not expert in all of them. And I am aware that commodities do move in cycles. I used to work in Africa in the 80s. They had a big commodities boom in the 70s. I was working in Africa in the 80s when the boom was over and the place was falling apart and they were defaulting on debt. So these long cycles exist. But gold is different. Gold is money. Now, in the short run, it can trade like a commodity because that's how people think about it. And the same money goes in and they trade futures contracts. They call it a commodity, et cetera. But every now and then, like commodities will go like this and gold will go like this or differently. But that's because gold is a different form of money. If you don't like dollars or don't like euros, you can go to gold.
So what will drive gold in 2017, Jim? Okay.
Well, right now, gold has a few headwinds, which are obvious. One is the strong dollar. When people say, is gold up or down, to me, gold doesn't go anywhere. I think of gold by weight. When I invest in gold, I'm like, okay, how much weight do I have, or how many ounces, et cetera. But most people think of it in dollars. So the dollar price of gold is inverse to the dollar. So a strong dollar is a lower dollar price for gold. A weak dollar is a higher dollar price for gold. So if you want to say what's going to happen to gold, you have to say what's going to happen to the dollar. Now, right now, the dollar is so strong, it's going to slow down the U.S. economy. By the way, it might get stronger, and the Fed's going to have to back off, as they did last year, and then sort of get in some dovish talk, and then gold could take off from there.
Okay, so, sorry.
I would say gold sideways for the next couple of months, and then I would look for a rally, kind of at the end of the first quarter, based on the Fed backing away from the strong dollar.
How much of a rally?
It could go back, obviously back up to the 1300 level. That was a prior baseline. So, and then see what the Fed does. Now, if the economy goes into a recession and the Fed's got to maybe cut rates or give forward guidance or talk about QE4, then gold could go a lot higher. Eventually, my price target is still $10,000 an ounce. That's not based on Fed cycles. That's based on systemic risk and the intrinsic price of gold relative to paper money.
Okay, so you don't think that the Fed will have this tighter, more aggressive tightening schedule in 2017?
I think they're going to talk about it and maybe do one rate hike in March. So they December definitely, probably one more in March. But by then, the dollar will be so strong, rates will be so high that it's going to be a major headwind for the economy. Then they're going to have to back off. Remember, this happened last year. They raised rates in December 2015. The stock market fell 11% from January 1st to February 10th. Then the Fed had to go all dovish and tear up their game plan for 2016. That could happen again.
Do you think that Trump will have a lot to do with the stronger dollar you anticipate? Because you've been speaking about the death of the dollar,
Sure.
so this is a bit of a reversal now, because you do think it's going to get stronger now?
Well, see, when people say that we have a strong dollar, they're saying that's compared to other currencies. They're looking at a dollar index, so it's like, okay, dollar is strong relative to euro, dollar is strong relative to yen, but they're all paper currencies. The thing is, they're all going to fall together. When I don't really talk about the death of the dollar. I talk about the death of money. That was the title of my second book, relative to hard assets, intrinsic value of gold, et cetera. So that's something to watch. That's more a function of systemic risk than business cycles. But right now, the dollar could get a little stronger on the index because the Fed's in a hawkish mode. I don't think Trump will have a lot to do with it one way or the other. By the way, Trump has been complaining that Yellen kept rates too low for too long. There are 2 vacancies on the Board of Governors. He's going to fill those vacancies on day one. At least he'll be able to. I expect he will. Let's see who they are. That's going to be see, the funny thing about Trump, he's a bundle of contradictions. On the one hand, he's talking about hard money. Why did Yellen keep rates so long? He might put some hard money people on the board. On the other hand, he's sort of a leveraged real estate guy in his DNA. Leveraged real estate guys love inflation. And that's also, inflation is a cure to the debt to GDP problem. Just inflate the debt away. Not bad for savers, good for debtors. The U.S. government's a debtor. So let's see what Trump actually does.
And you don't fear the inflation word?
I think it's terrible. Well, I don't fear it because I have gold, and I recommend people get 10% gold, and they can sleep at night.
Jim Rickards, thank you so much. So you're positive as we head into 2017. I'm sensing that from you.
Yes.
All right. Thank you so much for joining us in studio.
Thanks,
and thank you for watching our Outlook 2017. We'll have much more for you, so be sure to stay tuned to Kitco.com. Thanks for watching.